Let me ask you something. If I told you that the average American with a 401k is going to retire with about $200,000 in it, what would you think? Maybe that sounds decent. Maybe that sounds low. Here's the part nobody mentions. That's after 30 years of contributing. And if you're planning to live on that for 20 or 30 years in retirement, you're looking at maybe $8,000 a year before taxes. That's not a retirement plan. That's a slow-motion crisis wrapped in employer matching and tax deferral. I'm not here to tell you 401ks are evil. I'm here to tell you that if you're blindly throwing money into one without understanding what you're actually doing, you might be making one of the most expensive mistakes of your financial life. Now look, I get it. You've been told your whole career that maxing out your 401k is the responsible move. Financial advisors love them. Your HR department pushes them during onboarding. Your parents probably told you to take advantage of the match, and they're not entirely wrong. But here's the thing most people don't realize. Contributing to a 401k isn't inherently good or bad. It's situational, and most people are in the wrong situation. Let me explain what I mean. The traditional advice goes like this. Contribute enough to get your employer match, because that's free money, then max it out if you can, because you get to reduce your taxable income today. Sounds clean, sounds simple. But this advice assumes something really important about you. It assumes you're in a higher tax bracket now than you will be in retirement. Think about that for a second. The entire benefit of a traditional 401k is based on the idea that you're going to make less money when you're 65 than you do right now. Does that sound like the plan to you? Because here's what actually happens. Most people contribute to their 401k in their 30s and 40s when they're making, let's say, $75,000 a year. They get a tax deduction and they feel smart. Then they retire with maybe $500,000 or $600,000 saved up if they did everything right, and they start pulling that money out. Except now, they're pulling it out in an economy where everything costs more, healthcare is wildly expensive, and their required minimum distributions start kicking in at 73. Suddenly, they're being forced to take out $25,000, $30,000, $40,000 a year whether they need it or not, and all of it is taxed as ordinary income. You just spent 30 years deferring taxes, and now you're paying them anyway. Possibly at a higher rate, possibly in a higher tax environment. The government didn't give you a break, they gave you a loan, and now they want it back with interest. Here's where it gets interesting. A Vanguard study from a couple years ago found that the median 401k balance for people aged 55 to 64 is around $61,000. That's the median. Half of people have less than that. And you're supposed to retire on that? The math doesn't work. It never did. But nobody talks about this because the system is built to keep you contributing. It keeps money flowing into the market. It keeps the financial services industry funded, and it keeps you believing that you're doing the right thing. You might be thinking, okay, but what about the employer match? Isn't that still worth it? And yes, absolutely. If your employer is matching 3%, 4%, 5%, you should take that. That is the closest thing to free money you're going to get. But here's the part people miss. The match is usually capped. A lot of companies match up to 4% or 5% of your salary. So if you're making $80,000 a year, that's $3,200 to $4,000. That's what you should contribute to get the match, not the max, not $22,500 a year if you're under 50, not even close. Because once you go past the match, you're just locking your money into a tax-deferred account that you can't touch until you're 59 and a half without paying a penalty. And in the meantime, you might actually need that money. You might want to start a business. You might want to invest in real estate. You might want liquidity for an emergency that isn't covered by your 3-month safety net. But you can't because it's all locked up in a retirement account that punishes you for living your life before 60. Let me give you a real example. Let's say you're 35 years old, making $90,000 a year. You're contributing $10,000 annually to your 401k, thinking you're being responsible. Over 30 years, assuming a 7% average return, you'll have about $1 million. Sounds great, but if you're in the 24% tax bracket now and you end up in the 22% bracket in retirement, you basically broke even on taxes.
You didn't win, you delayed.
Now, what if instead you contributed just enough to get your employer match, let's say $4,500, and you took the other $5,500 and put it into a Roth IRA or a taxable brokerage account? You pay taxes on that $5,500 now, but it grows tax-free if it's in a Roth, or you get more flexibility and control if it's in a brokerage account. You can access it whenever you want, you can rebalance without restrictions, you can take advantage of opportunities when they show up. You're not waiting until you're 65 to live your financial life. This is the shift most people never make. They think retirement planning is about deferring everything until later, but later is not some magical time when everything gets easier. Later is when you have less energy, fewer options, and a fixed income. The time to build wealth is now. The time to have control over your money is now. Now look, I'm not saying don't save for retirement. I'm saying be strategic about where you're putting your money. A 401k is one tool. It's not the only tool, and for a lot of people, it's not even the best tool. If you're young, if you're in a relatively low tax bracket, if you think you're going to make more money in the future, a Roth IRA makes way more sense. You pay taxes now when your rate is lower, and you never pay taxes on that money again. Not on the growth, not on the withdrawals, never. Or if you want even more flexibility, a taxable brokerage account gives you complete control. Yes, you pay capital gains taxes, but long-term capital gains are taxed at 15% for most people. That's lower than your income tax rate. And you're not locked in. You can pull money out next year if you need to. You can invest in individual stocks, ETFs, index funds, whatever you want. You're not limited to the handful of overpriced funds your employer picked for your 401k. And here's the psychological part that nobody talks about. When your money's locked away in a 401k, it doesn't feel real. You see the balance grow, sure, but you can't touch it. You can't use it. It's this abstract number on a statement that you check once a quarter and then forget about. That creates a weird relationship with money. You start to think of your real financial life as separate from your retirement account, and that's dangerous because it makes you less intentional with the money you do have access to. But when your investments are accessible, when you can see them, manage them, move them, suddenly you're more engaged. You're thinking about asset allocation. You're thinking about tax strategies. You're thinking about how to actually build wealth instead of just hoping the market goes up for 30 years. Here's the other thing. The 401k system is built on the assumption that you're going to stay at one job for a long time, that you're going to have a stable income, that you're going to retire at 65. But that's not how careers work anymore. People switch jobs every 3 to 5 years. People have side hustles. People retire early or semi-retire or build portfolio careers. The traditional 401k model doesn't fit that reality. It's a relic from a time when you worked at the same company for 40 years and got a pension. That world is gone. So what should you actually do? Here's my take, and this is going to depend on your situation, but this is the framework I'd use. First, contribute enough to your 401k to get the full employer match. That's step one. Don't leave free money on the table. Second, max out a Roth IRA if you're eligible. That's $7,000 a year if you're under 50. That should be your priority after the match because of the tax-free growth and flexibility. Third, if you still have money left over and you want to save more, then you can go back to your 401k and contribute more. Or you can open a taxable brokerage account and invest there. But the point is, you're being strategic. You're not just dumping everything into one account because someone told you that's what responsible people do. And if you're thinking, well, I don't make enough to max out a Roth and contribute extra to my 401k, then you definitely shouldn't be maxing out your 401k in the first place. That money is better spent building an emergency fund, paying off high-interest debt, or investing in yourself through education or skills that will increase your income. A 401k is a long-term wealth-building tool. It's not a fix for a broken financial foundation. The Federal Reserve has data showing that almost 40% of Americans couldn't cover a $400 emergency without borrowing money or selling something. If that's you, you have no business putting extra money into a retirement account you can't access for 25 years. You need liquidity. You need options. You need to build a base first. This isn't about being anti-401k. It's about being pro-strategy. It's about understanding that personal finance is personal. What works for someone making $200,000 a year with no debt and a 6-month emergency fund is not the same as what works for someone making $60,000 a year with student loans and rent that takes up half their paycheck. But the advice given to both people is often identical. Max out your 401k, and that's insane. Here's the bottom line. Your 401k is not a magic wealth-building machine.
It's a tax-deferred investment account with a bunch of rules, restrictions, and assumptions baked into it. And if those assumptions don't match your actual life, your actual goals, your actual tax situation, then you're playing the wrong game. You're optimizing for someone else's version of retirement instead of building the financial life you actually want. So before you automatically increase your 401k contribution because you got a raise, or before you max it out because some article told you that's what smart people do, stop and ask yourself, is this actually the best use of my money right now? Because if the answer is no, if you'd be better off with a Roth or a brokerage account, or paying down debt or investing in an opportunity that's in front of you today, then you need to have the courage to do something different. The goal isn't to have the biggest 401k balance. The goal is to build wealth in a way that gives you freedom, flexibility, and control over your life. And sometimes that means putting less money in your 401k, not more.